I found this hidden stock called InPost, which grows revenues at 43% per year. And if you want to find out if this stock will 10x from here, then this will be the most helpful video you watch today. It's a logistics company that is still led by its founder and is expanding internationally. So is InPost ready to grow 10x from here? Let's find out using our 10-step Multibagger Framework. By the end, you will know exactly how it scores on the Multibagger Scorecard and if it's a buy when you are looking for a 10x stock. But every multibagger must first clear our 3 decision gates, the filters that we apply when finding a stock that should 10x or even 100x in the future. These decision gates are the opportunity gate, the management gate, and the entry gate. So can the business grow and keep those returns high? Are leaders able and aligned with shareholders, and are we buying in at a fair price before the market catches on? Now let's do a company overview of InPost before we jump to gate 1. So what is InPost? InPost is a logistics company that builds and runs automated parcel lockers. People drop parcels into lockers and customers pick them up at their own convenience. This model reduces failed home deliveries. That means fewer redeliveries and lower cost per parcel. InPost started in Poland and became very big there. That domestic success funded their growth into new geographies like the UK, Iberia and France and other European markets. They scale organically with their concept and acquire local logistics players to grow faster. More on acquisitions in a minute. They integrate with platforms like Allocation, Amazon and local e-commerce players and have their own app for sending, tracking and receiving parcels. They also offer additional services like last mile delivery to doors, they offer fulfillment services, they handle returns and even do cross-border parcels. These services increase the average revenue per parcel, that means higher potential margins than lockers alone. And when we see the strategic acquisitions that they made to scale faster, these are funded by cash and debt. They acquired Mondial Relay in France to grow fast in this geography. In the UK, they bought Yodel and Menzies distribution to scale in the British delivery. And in Spain, they bought Sending to add local fulfillment and couriers. These deals gave InPost more delivery centers and more routes. That means faster reach in new markets, and we can expect them to continue this strategy in the future. InPost is very capital intensive. This means lockers and fulfillment centers cost money. They need to spend upfront to get scale benefits later. This growth is also funded through taking on more debt, and the strategy is easily reapplicable in the future. The company is led by its founder, who holds a meaningful stake in the company. It trades in London, Germany and the Netherlands, and the market cap is at around 5 billion euros, which is about 5.7 billion US dollars. Now let's see if InPost could grow 10x in stock price from here. We test growth, Moat, Runway and returns in the opportunity gate. For the growth, we see that InPost grew revenues and margins at about 26% per year over the last 5 years. They executed impressively, but can they keep this up? Analysts expect revenues per share to grow at about 26% compounded annual growth rate over the next 3 years. Earnings per share are expected to come in at about 20% per year. This means InPost will grow further, and most growth comes from expanding into new geographies and acquiring new businesses. For the full year of 2025, InPost expects revenue growth to come in at about 40%, which is mostly due to the acquisition of Yodel. Margins will improve internationally, but they have margin pressure in Poland due to competition with Allegro. More on that in a minute. In total, InPost scores a 4 out of 5 for growth. InPost's advantage comes from scale and convenience. So when we look at the moat, we see that InPost has the network of lockers and hubs in place, so the fixed costs stay the same even when the count of parcels grows. More volume means lower cost per unit and stronger pricing power. Scale is a major structural advantage and the clearest long-term moat for InPost. In core markets, people know and trust InPost for parcel pickups and returns. That trust speeds merchant sign-ups and consumer adoption. Outside these markets, the brand is weaker and must be built first, so strength is regional rather than international. We can see that InPost is the preferred option in Poland. And in Europe, they have strong brand trust depending on the country, with a very high brand trust for Mondial Relay in France. Price-wise, InPost offers a clear pricing advantage. They have both lower prices when sending to a locker and when sending to a home address compared to competitors. Also, the fact that you can choose between those two options is something that the competitors don't have. They have an app in place that improves customer satisfaction, which leads to more parcels being sent via InPost. One negative point is the dispute with Allegro in Poland. Allegro removed InPost as the default delivery option, cutting a significant share of InPost's parcel volume. Instead, they put themselves as default delivery option, as they are growing their own delivery network. Allegro is Poland's biggest e-commerce platform, more like Amazon than any courier. Allegro says this change reduces shipping costs and improves the buyer experience, but InPost filed for arbitration, claiming Allegro breached the agreement and caused financial harm. If Allegro keeps the change, InPost could lose volume, pricing power and margins in Poland. A legal win might, however, restore the volumes or trigger compensation. Overall, the Moat is operational and scale-driven and deserves the score of 3 out of 5. Looking at the runway, we see how much room InPost has to expand. InPost has a clear path. They expand their network of stations and hubs in their geographies and expand into new geographies. They want to dominate out-of-home delivery across Europe with a dense network of lockers, strategic merchant partnerships with firms like Amazon, Vinted and Allegro, and want to expand using targeted mergers and acquisitions. InPost will grow fast outside of Poland through acquisitions and high capital expenditures. Out-of-home deliveries, like using lockers, is gaining share versus home delivery. It is cheaper and reduces the probability that you lose the parcel or it is being stolen. InPost is expanding in the UK and Spain after acquisitions. More countries will join InPost geographies in the future, and we see that they have a very high market share in Poland, but in the UK and France they have lots of room to grow. They can also add services like fulfillment and returns. That raises revenue per parcel. The core vertical will remain e-commerce logistics, however. And another point that I found is that there are new rumors saying that InPost could start their own e-commerce platform to go into a competition with Allegro and build this e-commerce platform in Poland, but also in the whole Eurozone. Overall, the runway is great and the score is a 4 out of 5. Looking at the return metrics, we see that InPost looks super solid. Return on assets is about 7%, that means assets generate decent profit. Return on invested capital is at about 12%, that means investments earn good returns after accounting for capital costs. And the return on equity is at about 41%, which is very good, but is influenced by the high leverage, meaning the high ratio of debt to equity that they have. We see that the metrics decreased over time. That means the way InPost used the capital got worse over time. This is a dark yellow flag and something we have to look out for. The changes in these metrics are mostly due to InPost's international expansion, for which they acquired new businesses. These businesses first need to be integrated into the InPost group, and InPost paid a premium for most of them. So these new businesses will improve these numbers that we saw here over time. The score for the returns is a 4 out of 5. So to recap the opportunity gate, we see we have great growth, a solid moat, a long runway, and a solid return to expect in the future. Now let's check out the management gate, where we look at the team, how they use capital, the health of the balance sheet, and if they grew the numbers of shares outstanding on the market. The management team. I love what we see here. We have the founder who is still CEO after 20 years and still eager to expand the business, called Rafał Brzoska. He built InPost from a small startup to an European operator. His ownership is at around 13.3% in total, partly via a holding company that he owns. That means the founder's wealth is tied to the company performance. That usually aligns incentives with shareholders. Management has shown that they can execute acquisition and scale operations across borders. Due to the founder-led, experienced and aligned management team, I scored a 5 out of 5. Coming to the capital allocation, we see that InPost reinvests most profits into the network. They prefer growth and capital expenditures over dividends, and in fact they have never paid a dividend in the past and are not expected to do this in the future. This is great as long as they keep achieving those higher returns on invested capital, called ROIC. That means they aim to compound returns rather than return cash now to shareholders. The acquisitions of Sending, Yodel and Mondial Relay show that they target companies for acquisitions to enter new markets. They are growing fast and stay in their target ranges for debt to equity, which is good, but brings an insolvency risk after all. Concerning stock buybacks, they buy back just enough stocks to avoid an increase in share count, which I like. For example, they bought back 0.1% of issued share capital in April to find the share inflation that comes with their employee incentive program. The capital allocation in total scores a 5 out of 5 for InPost. Now to the balance sheet. This is a main concern because the debt to equity ratio is about 323%, which is high. That means the company uses a lot of leverage. Leverage raises the risk if cash flows weakens. And just to show you, this ratio was elevated all the time, corresponding with acquisitions. The value should ideally be not over 2.5. The so-called current ratio is about 0.61. That means short-term liabilities exceed short-term assets, which poses a liquidity risk. Cash is positive, but liquidity is tight relative to short-term obligations. Because of these risks, the balance sheet scores a 2 out of 5. But in the end, we need to trust that the management team is competent in their risky strategy of growing with debt. Concerning dilution, we see that the share count has been stable. The 4-year average dilution is about minus 0.03%. That means shareholders still get the same share of profits that they did when they first purchased the company. They have not been diluted. This is very rare for capital-intensive growth firms, and this is because InPost growth not via new equity, but via debt and cash flow from their Polish operations. I don't expect their capital deployment strategy to change in the future, so I expect this dilution to land at 0% across the next years. For dilution, InPost scores a perfect 5 out of 5. So to recap the management gate, everything is perfect except for the balance sheet. InPost uses a middle to a high ratio of debt to equity to fund the expansion. While they keep their debt ratios manageable, this still poses a risk. Now to the last decision gate, the entry gate, where we test valuation and market size. Let's first look at the multiples. So InPost's PEG ratio is about 1.2. That means price relative to the growth of earnings is fair. The rule of 40 is about 52%. This metric looks at revenue growth and the EBITDA margin. 52% is a strong value, and with it being above 40, this is very good. The price to sales ratio is a 1.82. That is low, but also because the business has low margins per default. When we look at history, the price to sales ratio is historically low. The average was a 3.25. Looking at the PE ratio, we see the same thing. It sits at around 24, but the average was 37. Taking together, the valuation is great at the moment, especially for the growth profile. But why is that? The market prices in the conflict with Allegro and a slowdown in growth in the profitable geography, which is Poland, which could impact margins and slow down international expansion. I expect this to be offset by the international markets, which become increasingly profitable now. So I scored a 4 out of 5 on the valuation multiples. The market cap sits at a 4.7 billion euros. That size means the stock is not a micro cap and not a small cap, but rather a mid cap company. That makes it bigger than I would like it to be. Large institutions already watch it, so a sudden huge re-rating is less likely, but possible if the Poland market share increases again. Multiple re-ratings are possible when the whole Allegro discussion is over. For market cap, InPost scores a 3 out of 5. So to recap the entry gate, prices are good compared to history, but growth might be slowing down and the company is maturing. Let's sum up the 10 metrics and the final score on our Multibagger scorecard. The moment you have been waiting for. Weighted and averaged, InPost scores a 3.89 out of 5. This is a great score, but slightly below our no-brainer threshold of 4 out of 5. That means InPost looks like a strong growth profile with real strength, but they also carry clear financial risk because of their high leverage that they use. This exposes it to risks like rising interest rates or soft parcel volumes. The CEO is seasoned, founder-led, and deeply aligned with shareholders. Earnings are consistently reinvested to fuel long-term expansion. For retail investors hunting for potential multibaggers, InPost deserves a spot on the watch list. This isn't a quick trade, but rather a long-term growth play. This video is not financial advice. Check out this potential 10x multibagger that scored above 4 on the Multibagger scorecard now. See you in the next video.